How do you manage the financial risk associated with interest rates? So, so this interest rate risk, remember, is about the possibility of you losing money because of changes in interest rate. The question is why? Because you might have an asset that gives you income based on interest rate. Or you might even have a loan, borrowings, yeah, that you have to pay interest that is also based on interest rate. It's not impossible. So you might some people even expect some payment to be made, and that payment might be tied to maybe rates, or maybe if it's a late payment, you get some interest on top of it or whatever. So whatever you have that exposes you to lose money whenever interest rate changes, then that exact thing is exposing you to interest rate risk. And what you are trying to do is to minimize that risk. So you want to minimize it, which means, take for instance, if you have a borrowing, that borrowing definitely might have an interest rate that is fixed. And if that interest rate is fixed, then if the market interest rate reduces, which means normally you're supposed to be paying lower if you have used market. If they have already fixed it, you'll be paying higher. And the fact that you are paying higher when you should be paying lower, you will not be perfectly happy with that. Because what you want is to always pay the cheapest available cost. The same way, you might have a floating loan, that is a floating rate interest loan, where you are paying based on what the market is saying. So, which means if the market is going up, your interest rate will be going up, and your interest expense as well will be going up, and you will not be happy. At that point, you will now be thinking, oh, had I known, I should have just fixed that rate so that I don't have to be paying interest rates that is very high. So you sometimes you can't tell. And that is the reason why you have to think about edging. Because, like I always tell you, edging is not an opportunity for you to make profit. Edging is not an opportunity for you to make money. Edging is just a strategy to minimize your loss. And listen carefully, is minimizing your loss. It doesn't mean that you can eliminate your loss. Sometimes you might be able to, depending on your strategy, but not all strategy for hedging interest rates will eliminate it for you. But one thing for sure that you need to know is that it doesn't stop you from making loss. The same way it might not stop you from making gain. But one thing you know for sure is that both gain and losses will be very minimized when you are hedging. So what we're going to look at now is, how do we go about it? This hedging of interest rate risk. What are the strategies? What are the instruments that we have to use? What do we need to do? So we're going to look into various strategies. Yeah. How do we manage interest rate risk? The first thing that I'm going to look at is the FRA, which I introduced to you briefly when we were looking at risk management in FM. Yeah. Forward rate agreement. Forward rate agreement. So FRA is a combination of two things. Please take note, because it's different from your typical forward you use in currency. In forward currency, all you needed to do was just to fix the rate and you do your transaction at that rate. That's all. It's all about the FX rate. But when you're talking of FRA, you're talking of the interest rate itself that you're trying to fix, and also there is a principal involved, which is the amount that you are actually trying to loan or they are trying to invest if it's a deposit. Because, like I said in my introduction, your interest rate risk will be as a result of either the loan that you have or the asset that you have. But both of them are giving you value based on interest rate.
So for FRA, few things I'm going to tell you that you need to note. Yeah, and the first thing is the fact that you need to know when to buy or when to sell. If you want to pay at FRA, which means you definitely have a loan, you have a loan at an interest, and you think most likely in the future, the loan that you're planning to take or the loan you currently have that is moving with the market rate, the interest rate might be going up. So, which means when you have a borrowing, remember your risk is always that rates will go up. So, which means you will prefer to fix your rate. So, your response is to fix the rate so that you don't have to pay at higher rate. You are happy to pay at lower rate, but you don't want to pay at higher rate. So you fix the rate. When you fix the rate, what does that do for you? Please take note. When I buy or sell, buyers of FRA will always remember when you buy something, you have to pay. Yeah. So that helps you to remember. Buyers will pay at FRA, which means your interest will be at FRA, your forward rate agreement rate. And the sellers of FRA will receive, remember, seller. If you sell something, you will be expecting to receive something. So that helps you to also memorize that at FRA rate. Yeah. So if you think about this, then you can see that if you have a borrowing, then it means that you need to be buying FRA. Yeah, such that you pay at your fixed rate. And since sellers usually receives at the forward rate agreement rate, then you know that if you have a deposit, then you should be a seller. If you have a borrowing, remember, you should be a buyer. But if you have a deposit, you should be a seller. Why should you be a seller? Because your risk is the fact that rates might come down. So if you know that rate is likely going to come down, you are happy to fix your rate and receive at that fixed rate. So you are happy to receive at fixed rate. So that's why if you have a deposit, then you want to be a seller in an FRA agreement. Very important to note this interpretation. Yeah, because if you have a deposit, which is an investment, this is like investment, that's what we're talking about. You are meant to receive interest income at the market rate or at the spot rate when you go into that transaction in the future. Yeah, so if you think in that future rate would have come down, then what you want to do is to fix a rate that your interest income will come in the future. And that's why you are using the FRA and you are happy to fix. So, how do you know when you make loss or profit on FRA? That's another thing I'm talking on under this first point of buying and selling. Because when you are buying, or you're selling. It's for a purpose. And that is how it helps you to hedge, because it is the profit or loss on your FRA that is being added to the real transaction. Remember what I said? You are always going to have the real transaction regardless, right? Apart from your FRA that is on interest rate. So, which means that the profit or loss that you're making on FRA will be added to your actual outcome of the transaction to really get your net position. But how do you get your loss or profit? One thing you need to first of all understand is the fact that whether you are a buyer or you are a seller, you will have to pay an amount, yeah, that is subject to the outcome of the spot rate. Yeah, subject to the market rate, yeah, or spot on transaction date. And how do you know how much you are going to pay? Think about it this way. If you are a buyer, what are you paying? You have to pay FRA, which is the agreed rate minus the spot. So, take for instance, if FRA has been agreed at 6%, and come on the transaction date, the market rate is doing 4%. For a buyer must be definitely someone that has borrowed money. So, which means this person has a loan. This person has a loan. If you have a loan and you have FRA fixed at 6%, and come on the day you want to really borrow your money, market is doing 4%, you could see clearly that you are disadvantaged, because you could have borrowed at 4%, but unfortunately you have borrowed at 6% because you have fixed yourself at 6%. So, which means this is a loss for you. That's why I call it you are paying. Remember, paying means you are making a loss. If you have to pay, it means you are making a loss. But if you are receiving, you are making a gain. So, and how much is that loss? FRA rate, which is 6%, less the spot, which is the market, at 4%. So you'll be paying at 2%. And so buyer pays at 2%, which means whoever sells this to him will receive this money that the guy is paying at the same 2%. Please take note. Very important. Similarly, the same thing goes for seller, but in a different direction. For a seller will have to pay, which means a seller will be making a loss, pays or making a loss using this formula. This time around, it's going to be at the spot, the market rate, minus the FRA. So, which means if you are a seller, which means you have a deposit, but that is when you sell, and you think rates will come down, so you agreed FRA, let's say at 7%, and come in the future when the transaction is about to take place, the market rate has now turned to 6%. It means you're going to be excited to say, yes, I knew the rate will come down. That is why I fixed at 7%. Look at it. Market is doing 6%, but it's no more my problem because I already had a rate fixed at 7%. And that is why if you see how much is this guy going to pay, spot is 6% and FRA is 7%. So this is a -1. In this case, he's not paying -1. Paying -1 means it's receiving 1%, and that is a gain. So it's a receipt. So please take note. So which means the seller receives 1% in this scenario. And if it was the other way around, he would have been the one paying, because by that time he fixed at 6% and the spot is doing 7% because it's losing. And that would have been a +1. That's the proper payment, proper loss. So please take note, because I don't want these negative signs start confusing you. Just note that that is the formula. If you're going, all you need to do is to just know one formula. You don't need to start confusing yourself. Once you know that the buyer is FRA minus spot, then the seller is spot minus FRA. Then you know that whatever happens to the buyer, opposite happens to the seller. Like in this scenario that I've given you now, where we discover that the seller will have to pay -1, which is the same thing as receiving +1, because there's nothing like paying negative. Receiving +1 means it is a profit for the seller. That means the buyer of this kind of contract is making a loss. And in that case, he will pay at 1%. Please take note. That's the very first thing you need to know about FRA. You need to know when you are buying and when you are selling, and also how your transaction can give rise to payment or receipt. Because this outcome 1% or 2% is what you need to add to your real interest, to your principal, to get your net position. Both of these gives you your net position of hedging.
Okay, that's the first thing you need to know. The second thing I'm going to mention is the quotes. The quotes that you are used to under FX, the FX tricks that we just finished, is different from the kind of quote you will see here. And also, you might be thinking maybe the quote would be like 5%, 3%, like that. But I'm going to get there. The first thing I'm going to tell you, first of all, is the fact that it has a nomenclature, a naming system that starts with the time between now and when the transaction is going to take place. So take for instance, if today is the year zero, and let's say this is January, that's today. Let's say January 1st, year zero today. If you are looking to have a transaction in 3 months, which means March 31st, you want to sign an agreement. The question is, this loan agreement that you are planning to sign in March, yeah, let's say this is signing date for the loan, yeah. If the tenor of that loan is 6 months, so this is 6 months, and the delay is 3 months. So today you are thinking of a transaction that will occur in the future, which is the signing of a loan agreement, and that loan will be a 6-month tenor. What you are saying there is, when you're looking for quotes, this is going to be quoted as, because the hedging period, remember, is 3 months. That's where it starts from. Because this is today that you're saying, okay, I don't know what the rate will be by the time I'm signing this loan in 3 months' time. So I want to do FRA today to manage the risk of that future. So which means I'm starting with 3 months, then dash. I know that this loan tenor is 6 months. It's not going to be dash 6, because that is a common mistake I've seen students making. Instead, because 3 months already gone, plus another 6 is 9. So that's 6 plus 3. Then that means what you are looking for is 3-9 FRA. So by the time we get into calculation and you are seeing different FRA quoted, you should be able to identify the right FRA quote you should be using. Because imagine in this transaction, they give you a quote, say, okay, maybe 5% to 3%. Then you have another one, 3 to 8 FRA. They give you maybe 3 to 6 or 4 to 8, like that, like that. You should know that all these ones are noises and they are nothing you should be using. Right? The code for 3-9 is what has to be relevant for you. The other way is they might also say 3 versus 9. It's the same thing they are saying. Whether they put dash or they put V, it's the same thing. The next thing you need to note about how this is different is the way the quote system is, which you might probably have seen an idea here. You remember when we're doing currency, we always say there is a buy rate and there is a sell rate. And we believe that bank will always sell at a higher rate than the buy rate. That is for currency. For interest rates, you need to understand the way the quote is slightly different. And it's not that the principle is different. The principle is still the same thing. And what is the principle? The principle is that the bank will always make money on the transaction. And which means if bank will always make money on the transaction, it means that bank will make sure that when people give them money, they pay interest on that money that is much cheaper than the interest that they will pay when they are giving that same money out to people. So, what am I saying? Naturally, what you will see is that in interest rate quotes, usually you will see it looking like the higher rate is being written first and the lower rate is written after. But whichever the case you see, the bottom line is that you must know that the bank will pay a lower rate for investing, which is people that are giving their deposit to bank. Will pay a lower rate for, let me put it to investors so that's clear. Lower rates to investors, whereas they will want to receive higher rates from borrowers. So investors are like the lenders, the people that give their money to the bank. So which means if you see a quote like this, it means that 5% is the borrowing rate and 3% is the deposit rate. First of all, before I move on, any question at this point before we build more on this? So what we are saying invariably is that when you have a borrowing, what is your risk? Your exposure is that you don't want interest to go up. Anybody that have borrowings will be so scared of this. And if you have deposit, your problem is that you want to make money and you will be having sleepless nights if interest rate is coming down. And if you are exposed to any of this and you want to use FRA, then that is what we want to learn right now. But remember what I said, anytime you are thinking of FRA, you need to remember that it is a combination of the FRA itself, which is the rate you are trying to agree for the future, plus the loan itself, the principal. Remember, very important. It's only when you have that combination that you can actually say, okay, you are hedging your risk.